So to start today's session, I thought it would be better to revise, so remind what we discussed 2 weeks back about bonds for the fixed income securities. We'll do a small exercise. Then let's see what is your level of understanding, and then move forward. For that, um, yes, we'll consider a bond. Assume coupon rate 8%, coupon frequency semi-annual, for simplicity assume face value 100, maturity say exactly 6 years, and the yield 12%. What is the price that you would pay? What is the price that you would pay? Coupon rate 8%, coupon frequency semi-annual, or frequency 2, face value 100, maturity 6 years, yield 12%, and price. What is the price? Can you work out and let me know the answer? The answer.
Hundred 9.828.
100.
9.828.
109 point. Okay. 109.828.
828.
Any other answers? Any other answers? Okay. Does it mean everyone else got the same answer? Any comments on this answer? Do you all agree with that answer? So no response. What does it mean? The silence. Are you in agreement with this answer? What I have to tell you is, if you remain silent like this, and if you don't do the whatever the exercise or example, you won't be able to complete this in a proper manner. So you have to do workings and participate, otherwise it will be difficult. I can give the answer, solution, but it won't help you that much. You do it by yourself, come up with your own problems, and try to understand the concept. So, basic concepts what we discuss, it seems you have not understood. Those who got this answer 109.828, can you explain me how did you get this answer? What is the method that you followed? Appreciate that at least one has done this and has the courage to tell that answer. So that's what we need. If you are to work in a treasury, you can't be silent. You have to do these things, challenge opinions, analyze the market, come up with your ideas. Otherwise, you cannot survive. You are not suitable to work in a treasury or treasury related, even risk management, back office. You won't be able. So can you explain what is the method that you follow?
I took the face value 100.
Mm-hmm.
It means coupon 8% means 8 rupees.
Mm-hmm.
For 6 years, I consider put the formula C cash flow divided by 1 plus R, that formula. So for interest, I took 6% because it's semi-annual. Uh, Based on that only, I calculated.
Okay, so you can see something. So that means you calculate the price as coupon 8 rupees divide by 1.06. Correct?
Yes, for 6 years,
For 6 years, how many cash flows?
6 cash flow plus that finally 100 rupees divided by 1 plus 0.6 for 6.
So there are another 1, 2, 3, 4, 5, 6. Final
No,
one.
second year, 8 divided by 1 plus 0.6 bracket 2, yeah, like that.
This one to the power 6.
6.
Okay. Any comments? Others? Any comments? First thing, once you put an answer, oh, even before you get the answer, what you have to compare coupon rate and the yield. What is the relationship? Coupon rate is lower than the yield. What does it mean? What is the range for the price compared to face value? We discussed premium, discount, and par. Trading with a premium or at a discount or at par. What does it mean? Can you remember? We discussed that 2 weeks ago. What does it mean? A bond is trading at a par. At par. A bond is trading at par. What does it mean?
Yield equal to coupon rate.
Yield equal to coupon? No. Trading at par doesn't mean that. In a way, yes. What does it mean? When yield equals to coupon rate, the bond is trading at par. What does it mean? What is the price of the bond?
Face value.
Price equals to face value. When we say the bond is trading at par, price of the bond is equal to the face value of the bond. So when it happens, when coupon rate equals to the yield. So if coupon rate equals to the yield, then the bond price is equal to the face value. We call it trading at par. So when do we say that bond is trading at a discount? So what does it mean? Trading at a discount. When are we saying that the bond is trading at a discount? What is the relationship? What's the price when we say it's trading at a discount?
Price is lower than its face value.
When the price is lower than the face value. What is the condition for that to happen?
And the yield is greater than its
Yield is greater than the coupon rate. When are we saying the bond is trading at a premium? We say a bond is trading at a premium when the price is higher than the or above the face value. That would happen when the yield is lower than the coupon rate. So therefore, even before you do any calculation, just by looking at these two figures, you should have some idea about the price. Would it be 100 or more than that or less than that? So just now let me know this bond, would it be trading at par, at a discount, or at a premium? Coupon rate is 8%, yield is 12%. with the discussion we had just now, tell me, at a discount or at a premium?
Discount.
At a discount.
Discount.
Why?
Coupon rate is less than the yield.
Coupon rate is less than the yield. Then the price should be less than 100. Correct? So then this answer is not correct. That's how you can get some idea whether your answer is correct or not. Before you jump into the question, go through the given information and see what type of answer that you would get and have some idea where are you moving or going towards. Now, once you get this answer, you know this is something wrong. At least try it. Something wrong here. The price should be less than 100, but for some reason I got this. At least try it there. Okay. Now tell me what went wrong in this calculation. Her calculation. Okay, anyone who got an answer less than 100? Has any of you got the got any other answers? Okay, if not, tell me what's wrong here. Is this the method, or is that the method, or something else, or the numbers, or the calculation errors? What went wrong here?
When take the face value, present value of the 100, the rate should be taken as 12%.
Sorry,
12%.
12%. That means
12%. No, last one, 100.
this one.
Yes.
This one only. It should be 1.12.
Yeah, 1, 2.
Others?
Others 1.06. It's okay.
Why is that? What's the reason?
We here we take the 8 means semi-annual interest. Therefore, it should be the rate should be considered as 6%. That means half of the 12%. But face value is a one-off payment. It should be discounted at 12%, I think.
Any comment on that? Any other comment? Is it correct? Okay, now you can try that. Make this 1.12. Do the calculation and let me know what's the answer.
So answer should be 91.14.
91. If you do this calculation
No, sir. I did it
No.
differently.
differently, what's your answer?
91.14.
1, 4. Okay. Just hold on. Someone, have you done this method or this way? Changing this discount rate to 12% or the interest rate to 12% and discount it by 1.12. What's the answer that you get? The one who got this
89.995.
point
89.995.
995. You use 1.06 for all these places.
Yes.
Okay. The one who got 91.14, can you tell me what's wrong here?
Sir, I take interest rate as 4 because it is paid semi-annual, no?
Interest
8%.
interest rate at 4. Why? Okay.
4 divided by 1 into 1.06 into 12. Because frequency is 12 now. 6 years into 2. Then plus 100 present value of the 100. 100 divided into 1.12.
So what you did, equals 4 to the power 12 plus 100 over
1.12 into 6.
1.12 into 6. Then you got 91.14. Is it correct?
$52.60, sir.
Sorry?
52.60.
You got 52.60. This is another answer. Is it correct? You got 91.14. Can you explain how did you get that answer? Can you explain, please? How do you get this 91.14.
No, sir, that answer should be 52.60 because I have taken that 91.14 because due to an error,
Mm-hmm.
I have
You followed
yes,
you followed this
yes, 52.60.
60. Okay. Any comment on this?
So I got a different answer. It's 83.22.
83.22.
22.
Okay. Can you explain how did you got that?
Yeah,
How did you get that? What's the
I got coupon as 4 and rate as 0.06. Then I discounted all the cash flows,
Hmm.
taken the present value.
How many cash flows?
12 cash flows are there. Final cash flow is 104.
Hmm.
1 to 11 cash flow value is 4.
So what you said is 4 divided by 1.06 plus 4 divided by 1.06 to the power 2.
2. Likewise, up to 11.
Up to 11. There are 11 terms. This one, last one with 1.06 to the power 11. Correct? Then
No, final one is 104
104
divided
divided by
by
1.06.
1.06 into 12.
So no,
Then
11 term is 1.06 to the power 11.
11, but still its cash flow is 4.
4, yes. 4 over like this.
Then I discounted and summed the values, so I got 83.23.
2, 3. So I'm not sure whether this figure is correct, probably, but this method is correct. This is the way that we have to do. That's the mistake that someone has done and got 109.828. She got the denominator correct, 12% divided by 2 because it's semi-annual, but she forgot to divide that coupon rate as well. Because coupon is, if you take 8%, you get the annual coupon, but it's semi-annual. Therefore, you have to divide it by 2. Each coupon, every 6 months, you get a coupon of 4 rupees. Then there are 12 cash flows altogether. If you take the last one as the coupon plus the face value. Otherwise, there are 13 cash flows, but in 12 periods. So this is the correct method. The problem here is you don't know what is the basic principle of this. What is the basic principle? How do you find the price of a bond? What is the basic principle? Not only bonds, many of financial instruments, the price or the value today is the present value of the future cash flows. That's the principle. Price equals the present value of future cash flows. Then whatever the problem or whatever the instrument that you have, what you have to do, first decide what are the cash flows and what are the timing of those cash flows, what is the applicable rate to discount those cash flows, then discount each and every cash flow at that rate and then sum the present values. That's what we have to do. So this is the correct method. You can try this and see whether you get 2, 3.
Excuse me, sir.
Yes.
So I want to know the method I was used. Is it correct or not? Can I explain?
Yes.
I take 4 divided by point.
Okay.
I used present value annuity factor. 4 divided by 0.06. 1 minus 1 divided by 1 plus 1.06 into 12 plus 100 divided by 1.12 into 6.
That's the problem. It should be 1.06 to the
6 to 12.
12.
Okay.
This is correct. This is using the annuity equation. Because first 11 sorry, if we break this into 2, 4 plus 100 over 1.06 to 12, these 11 terms can be considered as an annuity. Then you can use the annuity equation or calculate the present value of the annuity. You can use that equation, but it gives you the coupon payments only. But there's another cash flow, which is the face value. We have to discount that maturity proceed back to 12 terms. It's again we discount at the semi-annual rate. Even though you get it in 12 years, you don't discount it in a different frequency. You use the same frequency because the bond is going on semi-annual basis. So therefore, you have to use the discount rate 1.06 or basically 1 plus R over 2 to the power 12. So always remember, whatever the interest rate that you use, you have to divide it by the coupon frequency. That's the general condition. You can't use 2 different frequencies in 2 different cash flows. This is also correct with that correction. Same principle. For the calculation purpose, we use this, but still it gives or follow the same concept. Take the present value of future cash flows. Present value of these cash flows, instead of calculating the present value of each and every cash flow separately and add them together, here you get the same answer in a different manner using annuity. Then there's another cash flow which is not included here. You calculate the present value of that cash flow separately, then add these two present values to get the final answer. That is also correct. If you go back and check the handout, so the examples we give, price is cash flow divided by 1 plus R over F plus C2 1 plus power 2. Likewise, nth coupon, whatever it is, to the power n, and the face value divided by 1 plus. This is the equation. This can be replaced with the annuity equation, which is assuming this C1, C2, all these cash flows in a bond, it is true. Fixed coupon bond, all these cash flows are the same. So we can write it as C coupon over R over F times 1 minus 1 over 1 plus R over F into the power n plus face value 1 plus R over F to the power n. So the best thing, remember the principle. What is the price of a bond? It is the present value of future cash flows. Then what we have to decide, what are the future cash flows? What are the timings? What is the discount rate or the applicable interest rate? And use that interest rate to discount each and every cash flow with the correct frequency. Any question? Any question? Is it clear now? Okay, shall we move into the topic today? If you have any questions, please let me know. And remember, in maybe next week or the after that, we will use the same equation and to discuss more about the duration, the interest rate sensitivity of a bond. So that risk side of the bond, we will discuss the same equation and use the same use this to calculate the duration as well. So shall I start this, or you have any questions? So it seems you don't have any questions. So we'll move forward. In this topic, it's mostly descriptive. You might have heard different names, different ways of referring to bonds or the securities. So we are going to discuss these terms and different characteristics of bonds. So what we discussed so far, it's the basic of bonds. So outline, there are different sectors of the bond market. You classify it depending on different characteristics of the nature. Then there can be different coupon rate structures. I just mentioned in the last or the previous class as well. Different maturity structures. What are the embedded options in bonds, and specific class of bonds, asset-backed securities and mortgage-backed securities. Just to give a brief introduction about asset-backed securities and mortgage-backed securities. So even though we have classified bond market into different sectors depending on different characteristics, there's no uniform system for the exact way of doing that. Depending on the market and the country, you may use different words or the different classification. But we are going to discuss here some classification which are mostly used or which is more familiar in the market. The bond market can be classified into different sectors based on these parameters or the variable. The first one is issuer type. Who is the issuer? Who is the borrower? Borrowers can be fall into different categories like government, agencies, municipalities or private firms, financial entities or international bodies, things like that. Based on that issuer type, that bond or classified into different categories. You use different or specific names. And the issue market, whether whether a bond is issued in the domestic market or in the international market or only on a specific market, depending on that, there are certain names given. Then based on the issuing currency, whether it's in dollars, rupees, or yen, or it can be a combination of the issue market and issuing currency as well. Then the coupon structures, whether it's a fixed coupon or a floating coupon, there can be different coupon methods. So based on that also, we classify that in using names. Then what are the provisions available in that bond to pay the capital or the principal amount? Based on that also, there are different classifications. Whether there are any options given to the investor or the borrower. Based on that, there are classifications, especially when there's a call option, we call it a callable bond, and when there's a put option, we call it a puttable bond. That's the main classification. Or convertibility, whether you can buy or convert a bond into shares and things like that. Then collateral, whether there is assigned collateral for that particular bond. Bond is issued with a backing of a collateral, specific set of assets. And based on the credit ratings carried by the specific issue. What is the credit rating of the bond? Based on that also, we use different classification. So we'll discuss each of them. So classified based on the issuer. And that means the issuer is classified into different groups. So in the world, there are governments. Each and every country, they have governments. So if the government issue a bond, we call it a government bond. Generally, it's a government bond, or sometimes we call it a sovereign bond. And whether it's issued by a state government. Like in Sri Lanka, state government is a sort of a provincial council. But in large countries like Australia, US, Canada, they have states. In Australia, they have South Australia or the Western Australia, likewise. So they have 5 states in Australia, Queensland. So whether that state, but it's a government, if they have issued a bond, we call them as state government. Even in US, there are states. In Canada also, there are states. Those states can issue bonds. Then those are called state government bonds. Then semi-government or the agencies. Those are agencies backed by government. It can be central government or the state government. Then supranational. Supranational means there are institutions set up by many countries. There are members, many countries as members of that institution. So they issue bonds, they borrow. Those we call supranational bonds. Then corporate, as we know, generally private companies, when they borrow, we call it a corporate bond. So government bonds, as I mentioned, also called sovereign bonds. And depending on the whether it's a long term or short term, we divide it into treasury bills and treasury bonds. Both are fixed income securities. Treasury bills are short term in the money market, treasury bonds in the capital market, more than 1 year. But in some countries, bills, notes, and bonds, say 10 years, they call it, especially US treasury notes. They don't call it treasury bond. They call it treasury notes up to 10 years. Beyond 10 years, they call it as treasury bonds. So as I mentioned, depending on the country and the currency, they may use different words, but still the basic is the same. The issue is a government. In the state government bonds, as I mentioned, issued by state governments or municipals. Say for Canada, Ontario is a one, Quebec is another state. So that state has a government. They can borrow from the market issuing bonds. Those are we called state government bonds. Or there can be, in some countries, even municipal allowed to borrow. But in Sri Lanka, it's not the case. That is one thing that we have to make sure. Before you enter into a transaction, you should know whether that transaction is legal. It may be a provincial council or Pradeshya Sabha, whatever. If they come and ask you, we want to borrow, first thing that you have to check whether they are allowed to borrow directly. In Sri Lanka, it's not the case. Everything will be borrowed from the central government and allocate the budget to these institutions. But in other countries, it's not the case. They have some autonomous to borrow by themselves to fund their requirement on their own. So therefore, they impose taxes. State governments, they impose taxes. So therefore, they collect the revenue. They have other income sources. Maybe within that state, if there's a toll road, that toll collection is collected by that provincial government or the state governments. Likewise, there are different revenue avenues. So mostly these state government bonds are backed by two sources. First thing is tax. That means that state borrow funds today, and that the future payments by future taxes. they say, okay, in the future we might have this much of tax collection. Out of that, we will pay you back this bond. That is the meaning of tax-backed bonds. Or the other one is revenue bonds. So they specifically allocate some form of revenues or the source of revenue, and the bond will be paid using that revenue. If that revenue falls, there may not be a payment if it is not adequate. So that can happen. In semi-government, as I mentioned, there are institutions not directly owned by the government, central government or the state government, but they have some sort of ownership or the control. The government is, or the institution is backed by the government. In Sri Lanka, we don't have that much of these things, maybe UDA, water board and things like that. But if you take examples from United States, there are institutions, say Federal Agency Securities. These are, Ginnie Mae is one of the institution, Freddie Mac, Fannie Mac. So they are issuing or giving or facilitating the housing loans. But that agency is formed by the government. Government backing is there. So, but they borrow their own. They borrow from the market and facilitate housing loan or mortgages through other. They have different set of mechanisms. Through that, they disburse that funds for mortgage loans, and they collect that funds and pay back the lenders. In UK Rail, that is the railway system. Even in UK, that means the track is maintained by centrally using this UK Rail. It's sort of a semi-government agency. So better you understand these things, how they operate these things. Then what do? They sort of lease that track to train operators. The train operators are privatized. They run their own trains, not the central government, but they lease the track because the infrastructure is costly. The government or through these agencies, they lay out that infrastructure and lease out that infrastructure to private firms to run railway. Even buses, the same thing. There are bus companies, they have to bid to get the route permit. Then that company is allowed to run that bus. Whoever who wins that bid, they are allowed to run that route. There are restrictions or the constraints within that the company has to operate the buses. In Germany, Bundesbahn, it is like UK Rail, that is the railway of Germany. The same thing. That is again a semi-government agency. They borrow funds to maintain the infrastructure, railway infrastructure. The income source is the rental or the lease income from the railway operators. In supranational bonds, as I mentioned, these are multinational organizations. I think better to list these few examples. Asian Development Bank. So Asian Development Bank is a organization owned by many countries. So it's not an entity belongs to one country. It's owned by many countries. IBRD, that's an arm of World Bank, International Bank for Reconstruction and Development. Headquarters in US, but it's again again owned by many countries. European Investment Bank, owned by European Union governments. Then there's another arm of World Bank, IFC, International Financial Corporation. Likewise, there are many multinational organizations. So they have a good creditworthiness because it's not owned by one country, it's many countries. Even one country fails, other countries can support that country and the institution or the organization. So therefore, these supranational agencies or the supranational organizations, they have a good creditworthiness and generally carries high credit ratings as well. Whenever this type of organization issue a bond, we call it a supra bond, or we categorize them as supranational bonds. That is purely based on the type of the issuer. Then the corporate bonds basically issued by corporate, but within the corporate sector, you may see some other subclassification, whether it's a secured bond. That means there can be some form of collaterals pledged into this issue. So if the corporate fails to pay the bondholders have the claim against that collateral pledged into this bond. So they don't want to wait until a liquidation happen to get their money back. Straight away, they have the claim against the pledged collateral. The other one is unsecured. So there's no pledge assets or collateral against this borrowing. So this is a naked borrowing. They just borrow with a promise to pay it back. If the corporate bankrupt, bondholders won't get anything unless there's anything that you can get after the liquidation process based on the priority that you are. So therefore, there's another classification, senior or subordinate. Say same corporate issue two bonds. In one, it may say it's senior. That means they get the priority claim against any other lenders. So in a liquidation process, the first thing is payments to the senior bondholders will be paid. Then if there's anything left, that will be distributed among the subordinated debt holders. So there's a seniority structure. Based on that structure, payments will be made in any liquidation for the bankruptcy event. Then medium-term notes, again, depending on the maturity period, corporate bonds are classified as medium-term notes, say generally up to 5 years, they call it medium-term notes. Commercial paper, short-term, like treasury bills, certificate of deposits, it's an interest-bearing instrument, whereas the commercial paper is a discounted product. So we discuss this commercial paper and certificate of deposits under money market. But they are corporate fixed income securities. You can say corporate bonds. Then depending on the market, as I mentioned, whether it's internal or external, whether the bond is issued within a particular country or open to the other countries, investors in other countries, or whether you in other countries, depending on that, again, you can classify. So domestic issuers are domiciled in the country. If a Sri Lankan firm or the Sri Lanka government issue within Sri Lanka, it's a domestic issue. Foreign, that means issuers are not domiciled in the country. Sri Lanka issue a bond in UK market, then it's a foreign. Foreign, the classification is in the as foreign market. Then the external, that is basically euro bond. If you can remember, when we discuss about money market and interest rates, I discuss about euro dollar deposit. And at that time, I mentioned, what does it mean, euro dollar deposit? It is not a euro dollar exchange rate. What does it mean by euro dollar? Dollar deposits place outside US. That is we call euro dollar. If you call euro yen, yen deposit outside or place outside Japan. Likewise. So that is the euro currency market. Even for the bonds, that is true. If a dollar bond is issued outside US, it is called as a euro bond. So basically, these issues are underwritten by international syndicates. So they are the international investment banks. They underwrite that transaction, and they plays the lead role in offering to the other investors. They market it in many countries, find out investors, and try to sell this out as much as possible. So therefore, it is offered to investors in many number of countries. It's not restricted to a one country. So it is issued outside the jurisdiction of any single country. But there can be a governing law. Most of the time, the governing law would be England law, UK law, English law, specifically. Say most of the time, it is under English law. So whatever the country, if there's any issue comes, they have to follow the English law and that judicial system to come to a finalization if there's any dispute. So those are we call external bonds or the external bond market. So in the internal market, domestic foreign means, say in Sri Lanka, if a Sri Lankan entity issue a bond, it's a domestic bond. If a foreign party issue a bond in Sri Lanka, it is a foreign issue, but in the internal domestic market. So as I mentioned, euro bonds, you can say euro dollar bond, euro yen, or it can be euro CAD or whatever. So issue outside of the domicile country. Dollar is belong to US dollar, sorry, US. If a US dollar bond issued outside US, it is called a euro bond. Then if a yen bond is issued outside Japan, it is called euro yen bond. So that is the euro bond market. Then the global bond, sometimes we call it a global bond. That means that bond can be traded in many foreign bond market, not specifically in a single bond market. So most of the euro bonds are global bonds trading more than one country. Then specific type of bonds issued in some countries are the sukuk bonds that based on the that complies with the Islamic religious law, or we call Sharia law. So because in according to their law, there's no concept called interest. They cannot earn interest, but what they do, they share the profits. So this bond or issuing certificate to the investors and promising that buying that bond, what this bondholders does, that purchase segregation or a portion of the assets. So they are purchasing some assets. Whatever the return generated by that asset will be received by the bondholder. That is the basic concept behind sukuk. There's no interest per se. So it's sort of a profit sharing mechanism. So therefore, in the sukuk bonds, these three major categories or the terms: what is the underlying contract, and the nature and type of asset represented. What are the assets backed by this bond? What is the nature? Then what are the technical or the commercial features? What type of ownership that a project or investment activity that you get, and what is the profit sharing? That is the basic of sukuk bond. You may read and know if you are interested about that, because that market is a now big segment in the global market. So if you need or interest in that, you can read and find out more. This slide gives you some comparison between normal bonds and sukuk bonds. So in normal bond market, when we say it's a bond, it's a debt security or obligation from the issuer. Issuer is bound to pay back to the bondholder. But when it comes to sukuk, it doesn't say it's a debt security, but it says it's a certificate, and it's not that bondholder has the obligation to pay, but sukuk holder may have the ownership depending on how the sukuk classified, and it can be a part ownership of a project or a asset or a set of assets. But it's not the case in a normal bond. Bondholder does not have any claim against the asset or set of assets, but against the company or the issuer in general. Whether that asset generate enough cash flow or not, the company or the bond issuer has the obligation to pay back, but which is not the case exactly in the sukuk bonds. So likewise, there are few other characteristics also you better go through and understand. So then it is the coupon structures. Fixed income securities, what we discussed so far, has a fixed coupon. When I say coupon rate is 8%, it is 8% throughout the life over the 6-year period in our previous example. That is we call fixed coupon bonds. The coupon rate is fixed at the beginning before issuance, and it will remain there unchanged throughout the life of the bond. So that is we call fixed coupon bonds. So the coupon rate is fixed, it won't change. But then there are another bonds, type of bonds, there's no coupon. That means there's no interim interest payments. But what the issuer promises to pay the principal amount only on the maturity date. There's no any other cash flow in between the issuance and the maturity. So therefore, investors will buy it at a deep discount. Whatever the price that paid and the price value that they receive, that difference is the interest income. So it is a discounted product. Zero coupon bond is a discounted product similar to treasury bill. The difference is Treasury bills are short term, less than 1 year, but zero coupon bonds are with maturities more than 1 year. It can be 5 year or 10 year. But bondholder has to wait until maturity to get any cash flow. But in a fixed coupon bond, what we discussed earlier, you don't wait until maturity to get a cash flow. You get an interest payment frequently based on the coupon frequency. So that's the difference. So generally, zero coupon bonds are traded at a substantially lower level or below the par value. Then another way of setting up coupon is step up notes. So there's no one fixed rate for the bond, coupon rate for the bond, but there can be at least two coupon rates. So, and it is increased over the time. It increases over the time. That's the thing. In a step up notes, always coupon rate increases in the future at least once. So in a single step up, there can be one increase on a future date. In a multiple step up, there can be more than one increases of the coupon rate. So this is an example of a 5-year bond with a step up bond. First 2 years, the coupon rate is 1%. Then the next 3 years, third year, fourth year, and fifth year, coupon rate is 2%. This is a single step up note, example of a single step up note. In a multiple one, there can be many or more than one increase or more than two coupon rates, but coupon rates will increase in with the time. You can see first 2 years 1%, next 2 years next year it's 1.5%, next 2 years, fourth year and fifth year 2%, sixth year to 10 year 3%, likewise. So this is step up. Coupon rate increases in the future. So then there can be bonds which allowed the investor to defer the coupon. So even though there's a coupon due, say for the first 3 years, the issuer does not need to pay it. That will be accumulated and paid after few years. So if it is a 3-year deferred payment, at the end of the 3 year only you get the coupons for the first 2 years as well. So that type of bonds we call deferred coupon bonds. So therefore no interest payments during for the deferred period, or there may be accumulated ones, so there may be no interest as well. In the floating rate notes, this is also like a step up bonds. Coupon rate changes, it is not fixed, but there's no guarantee that the coupon rate will increase. It can be increased or it can be decreased depending on the market condition. So in that case, there's a coupon rate formula or the coupon formula. Based on the formula only, the coupon rate changes. So in that formula, there's a reference rate which can be observed in the market, and based on the credit rating or the credit risk of the issuer, a margin will be added to this reference rate. At the beginning, this margin is fixed. Then thereafter, you cannot change the margin. That margin will be remains throughout the lifetime of the bond, but that reference rate will be changed frequently with the given at the given frequent. This reference rate will be changed. Then that reference rate plus margin would be the coupon rate for the until the next revision happens. So there can be formulas with reference rate plus quoted margin or reference rate minus quoted margin. So you can see the inverse relationship here. If the reference in the first instance, when the reference rate increases, margin will be added, it will go up. In the second one, reference rate margin or minus quoted, so you will get a lower rate than the reference rate. So this is an example based on the LIBOR, 1 month LIBOR. So the coupon formula is 1 month LIBOR plus 100 basis point. So every 1 month, this will be reset because the reference rate is 1 month LIBOR. Every 1 month LIBOR changes. So LIBOR changes daily, but since it is fixed for a 1 month period, after the 1 month period, the interest rate will be fixed for the coming 1 month based on the LIBOR rate available in the market on that date. So the second one is another example. The reference rate is in this case is the 5-year treasury yield. What is the 5-year treasury yield? But minus 50 basis points. But in this also, even though it's 5-year treasury yield, you need not to wait until 5-year to change the reference rate. It can be done monthly because every month end you can find what would be the 5-year treasury yield. Or every 6 months you can check what is the current 5-year treasury yield, apply that to the coupon formula. But the thing is, this benchmark rate is available in the market. Then there's with these floating rate notes, there are two other concepts, cap and floor. What does it mean by a cap? So say in a formula like that, if the interest rate increases, 1 month LIBOR increases, coupon rate increases. But there can be provisions in the covenants of the bond issue. The coupon rate can be increases, but only up to a particular level. That is we call the cap. Even though the reference rate goes beyond that, or reference rate plus 100 basis point moves above a certain level, the coupon rate will be fixed at that cap rate. The floor is the opposite. What is the minimum interest rate? Cap is the maximum interest rate that will be paid as the coupon. So in this, there's an example with a cap. So it says coupon rate equals 6-month treasury yield plus 50 basis points with a cap of 3.5%. So on the first reset date, 6-month treasury rate is 2%. So what is the coupon rate? What is the coupon rate on this date? 2% plus this 50 basis points. What does it mean by 50 basis point? What is the coupon rate here?
2.5%.
2.5%. 50 basis points means 0.5%. So it is 2.5. What is the coupon rate for the second period? It is 2.8%. For the third period, it is 3.3%. Correct. 2.8 plus 0.5, it is 3.3. What is the coupon rate for the fourth period?
3.5.
It is 3.5. Why?
Cap is there.
The cap is there. Even though you add 0.5% to this 3.3, you get 3.8, but the cap is there 3.5. So you won't get more than 3.5. The fifth also the same. It is already exceeded the cap 3.5. The sixth period, it will be 3.1. So because 2.6 plus 50 basis points, it's 3.1, which is lower than the cap rate. This is the way that floating rate note works. Even in Sri Lanka, we have floating rate loans, but I don't know whether there's any frequency reset. Frequency properly set it in these loans, and what is the benchmark rate? Nothing is there. The banks do it arbitrarily on their own. So that's why our market is not developed. There's no transparency, nothing. If you go by this, everybody knows what would happen. When the interest rate goes down, our banks, they don't reprice that loan interest, even it is agreed for a floating rate. If they wish, they do it revise downward. If not, no. But when it goes other way around, they will do it very quickly. So that's why we need this type of proper mechanisms to then people will engage this type of transaction, because they have more certainty and they know if there's any advantage, it will be passed to the customer. Then there's another type called inverse floaters. You can see in this floating rate notes, the coupon rate will move in the same direction with the interest rates, with the reference rate. If the reference rate increases, coupon rate increases. If the reference rate decreases, coupon rate decreases. In the inverse floaters, it is other way around. If the reference rate increases, coupon rate decreases. You can see fixed amount minus the proportion of the reference rate. So 5% minus 3 times 6-month LIBOR. If the LIBOR rate increases, this will go down. Definitely there will be a flow at 0, because coupon rate cannot be negative. That is the inverse floaters. Then in some other countries, there are bonds which are linked to inflation. Even in Sri Lanka, at one time we had these inflation linked bonds, but it was not a success in Sri Lanka. That inflation linked bonds provide a protection against the inflation, because it may be either interest formula will be changed or the coupon rate will be changed over the with the inflation, like given in this inflation rate plus 300 basis points. But there are some inflation linked bonds, the principal is adjusted with the interest rate and apply the same coupon rate. So that also gives you a high interest when the inflation increases. So that is inflation linked bonds. Again, the interest amount is not fixed in this type of bonds. It can go up and it can go down. Again, there can be caps and floors, especially in inflation linked bonds. It doesn't allow the principal amount to go down below the original, even though inflation goes down. Then the maturity, based on the maturity, principal payment, repayment mechanism, there are bonds called bullet maturity, which I explained 2 weeks back. What does it mean? You get the principal amount as the investor only at the end of the period or only on the maturity date as a lump sum, single cash flow. Issuer is not required to make any principal repayment prior to the maturity date. Other than interest payments, no principal payment is made prior to the maturity date. On the maturity date, the full principal will be paid. That is a bullet maturity. In contrast to that, amortizing securities, that means there's a schedule. Based on that schedule, part of the principal will be repaid to the investors. So this type of securities are mostly common when the security is backed by a pool of loans, because in that pool of loans you get part of principal and part of the and the interest as well. So you pass that same cash flow to the bond investors. That's why there's a amortization schedule. So this is almost like a mortgage loan that you know. The investor will get interest plus the part of the principal. So therefore, for the next term, principal value goes down. Then based on the currency denomination, whether it's issued in dollars or rupees or yen, Indian rupee, whatever, we call it as dollar denominated bonds or rupee denominated bonds or yen denominated bonds. So it does specifically mention what is the currency. But there are another type of bonds which are called dual currency bonds. Again, dual currency bonds, there are 2 types, but the primary one is you invest in one currency, say dollars, maybe your coupon payment is in some other currency, not in dollars. It may be in rupees. That is one way. The second one is like, say you want to invest in Indian rupee bonds, sort of. They give you the dollar denominated amount. So you invest it in dollars. They pay it in Indian rupees and converted that rupee amount to dollars back and give you in dollars. So there are small variations in different dual currency bonds, but basically when you say it's a dual currency bond, the basic form is principal is paid in one currency and the interest is paid in another currency. So there are variations in dual currency bonds. So basically what does it mean? The bond is or denominated in more than one currency. That's what meant by dual currency bonds. Then the embedded options in the different bonds. As I mentioned, callable bonds. This give a option to the issuer or the borrower to repay the principal amount before the stated maturity date. So the borrower can redeem that before the repay before the maturity, but not that on his or her own discretion. There should be a provisions given in the bond prospect or the term sheet. When the bondholder can recall it, what are the conditions to be met, and things like that, or what are, if it is allowed only on a certain date, or whether it's allowed after a particular date anytime. That type of provisions are included in the bond covenant. So, and the call price, what is the price that the bond issuer repay to buy back that bond, whether it's at par or above par or at the market price. That has to be given, mentioned in the bond covenants, in the deferred call. So he's eligible, issuer is eligible to call it, but he can defer it. And what is the first call date? What is the first date after the issuance the bond issuer can call this? Then whether it's after first call date, whether anytime the bondholder can call it, or should be done according to a schedule. There will be a schedule, different various days. On that day only the issuer can call it, and the price also given in that schedule, in the call schedule. However, basically issuer will call the bond if the interest rate is going down, because he can borrow at a cheaper rate and pay for the previous borrowing at a higher rate. Then its interest cost will be reduced. It is a disadvantage for the bond holder. So therefore, initially, when you are buying a bond as an investor, you get a discount. Or on the other hand, the premium or a price is paid by the issuer because he is buying an option. He is getting some advantage if interest rate goes down. So he has the option. So he has to pay for the premium. But then you have to distinguish these two: non-callable versus non-refundable. Non-callable means whether the bond can be called or not now. After a certain date, if it is a callable bond, bondholder may be bond issuer may be able to call it and pay back the principal to the investors. If it is not fall in a call period, it is called non-callable. But non-refundable is some different. It prevents redemption from certain sources or proceeds of other debt. Say, if the bond is callable, but it prevents the borrower by issuing a new bond and pay to the existing bondholder. That is prevented. That is non-refundable. But it may be from its income, whatever the income sources, maybe profit. The firm has extra profit, no need to keep it. So therefore, firm would like to pay back the bond. That type of proceeds may be used to call the bond. So that is the difference between non-callable and non-refundable. Non-callable means whether the bond can be called or not. If it is not, it is non-callable. Non-refundable means whether even a callable bond can be repaid using some sort of funding, whether that funding source is allowed or not. That's the difference between callable and non-refundable. Then the puttable bond, that option is available for the bond investor. Bond investor who has bought the bond can ask their money back before the stated or the final maturity date. This will happen when the interest rates is going up, because investors can invest that money at a higher rate. So this option is available to the bondholder. Therefore, when the investor buys that bond, the buyer pays a premium to the issuer. So pay a slightly high price compared to a non-puttable bond with the same characteristics. In the convertible bond, that's convertible option is another option which can be embedded into a bond. So that grants the bondholder the right to convert the bond for a specified number of shares of common stock. A corporate has issued a bond with a convertible feature for the option, then the bondholder on a specific date can convert that bond into a given number of shares of common stocks of that particular company. So if it is worth than holding the bond, the bondholder may switch his claim from bond to a common stock. Then the bondholder becomes a shareholder of the company. So thereafter, no more interest payment, so principal payment would happen. Only the share holdings, then value of the investment may change with the share price movement. So then the asset-backed securities. So I think better we'll take a break here, because if we start this, we have to go through this one stretch. It takes time. So we'll take a break about 15 minutes. Then we'll start discussing asset-backed securities. Before we stop for a break, is there any question on what we discussed so far? Any question? Shall we start, please? Are you ready? So we'll 10:45. Okay, we'll move forward. So probably I won't be able to go until 12:30. So let's see. Okay, asset-backed securities. I hope you can hear me. Can you hear me?
Yes.
Yeah. Okay. Sure. So asset-backed securities. So basically, asset-backed securities are bonds issued by a particular issuer, but generally in other bonds, the payments to the bondholders or the investors is the obligation of the issuer. Whatever the income source, whether the bond is paid by borrowing another issuing another bond, it doesn't matter. Only thing is the issuer has the obligation to pay it to the bondholder. But in the asset-backed securities, it's slightly different, because when the bond is issued, the issuer gives us another set of assets, pool of assets, and see, whatever the cash flow generating from this set of assets will be used to pay the debt. That is why it's called asset-backed securities. If that set of assets won't perform in the future as expected, then there won't be any cash flows to the, or maybe less than the expected, to the bond holders. That is the basic concept. So therefore, asset-backed securities derive their cash flow from a pool of underlying assets. What is this pool of underlying assets? That may be vary from issuer to issuer and type of the issue. So, and we give specific names depending on the type of assets. So one example is mortgage-backed securities. It is a specific type of asset-backed securities. The underlying pool is the mortgage loans. So there can be 1,000 or 100,000 mortgage loans given to individuals. Then monthly there will be a cash flow. Based on that, the issuer new bond to the market. So there will be investors. Investors will buy that security. Then the issuer will get a cash flow. Issuer can give more loans to the customers. That's what happened. So investors will receive from his cash flow depending on the performance of the mortgage loans, which are attached to the specific bond to back that bond. So another one is CAS, Certificate for Automobile Receivables. This is not common in Sri Lanka, because but in developed countries there are loans given to automobiles. So whatever the receipt of those loans are used to back the bond, or maybe revolving debts cards. That means specifically to say credit cards. So there are so many credit cards, and there are credit cards receipts which are to be received in the future. Based on that, backed by that asset, a bank or the card issuing firm can issue a bond to the investors. That's what happened in this. So likewise, in other countries, there can be student loans. For students in other countries, they give loans to go to universities or for higher education. But then there will be a payment back. Backed by that flows, they can issue securities. Home equity loan securities also, or same type. So in general, these asset-backed securities are backed by a set of pool of underlying assets or set of underlying assets. This underlying asset can be a particular type like mortgage back or the student loans or the credit cards, or sometimes it can be a collection of all these things. One issue may be backed by part of mortgage, part of student loans, part of credit cards, and things like that. In general, we call them as asset-backed securities, but if it is specifically underlined by the mortgage-backed securities, we call specifically backed by mortgage loans, then we call it mortgage-backed securities. Likewise, there are specific names given. So therefore, the payments will be backed by the interest and principal payments made by the pool of borrowers, basically that pool of assets. So whatever the interest payment comes through that principal payments, those are used to pay back to the investors. So initially what the issuer does, pool them together, know that, okay, within a month, this much of cash flow will be there. Interest income this much, principal repayment this much. So pool it together, then keep part of it for operational expenses or maybe allocated to another reserve. Then rest can be used to pay for the bond. So considering all those things, decide what is the amount that the issue is going to borrow from the market, what would be the interest rate, because individual loans may be at different interest rates. Then they may have to calculate the weighted average interest rate, then keep a margin for the reduce the margin for operational expenses and set aside for a reserve or things like that. Considering those, the interest payment to the bond will be decided. That is what is called here prepackage. You can't pass the inflows as it is to the investors. So you develop a new product based on these cash flows. So basically, this is what happened. Fixed income assets, this may be the mortgage loan or the student loan. Then there will be payments on a frequent basis, monthly or quarterly, principal and interest amounts that will be used to pay for the asset-backed securities. Not everything what you receive here. You deduct interest expenses, operational expenses and things like that. Then the rest is used to pay for the asset-backed securities. So the pool of assets are standardized. That means generally they try to use assets with similar characteristics. Otherwise, it would be difficult to handle this process and manage the bond asset-backed security. So that's what it does mean, standardized. So try to be almost same loan given to different individuals, but with this almost same conditions, or try to make it similar. Then the thing is, you have to give that control of the asset pool into a trust. Otherwise, there can be a misuse. The original lender, when they receive cash flows, they may use that for other purposes. To avoid that and to safeguard the investors of the asset-backed securities, this underlying assets are transferred to a trust. We call it special purpose vehicle. So it's a trust that take care of the set of assets which are backed by the, or which is backed the security. Then the original lender may not have control over this asset pool. What they can do, collect the cash flow and pass it to the trust. That duty is with the original lender. So then there can be different structures, these pass-through structures, multi-class structures. In a pass-through structure, basically what do they do? Whatever the cash flow comes from the set of assets, pass it directly to the same manner of keeping a margin to the investors. In a multi-class structures, the bond is issued in different tranches, different classes. Some get the priority and different interest rates. In another class, maybe higher interest rate but with high risk. There can be equity tranche. We call it senior tranche, mezzanine tranche, and the equity tranche. Equity tranche takes the risk, highest risk. So therefore, they will be paid at a higher interest rates. Likewise, so they tranche into at least 3 categories, and depending on the cash flow, the payments will be made. So basically, in a structure like investment tranche, mezzanine tranche, or the senior tranche, mezzanine tranche, and the equity tranche, the first thing is whatever the cash flow is used to pay for the senior tranche. Then if there's any cash flow left over, that will be used to pay for the mezzanine tranche. Both are paid. Still there's enough cash flow that will be used to pay for the equity tranche. If there's not enough cash, then equity tranche holders won't get any payment. They take the loss. That's how it is structured. So based on that, senior tranche may get a higher rating, but the equity tranche will get a lower rating. So senior tranche has a low risk, equity tranche has a high risk. Therefore, senior tranche coupon payment or the interest coupon rate would be low, but in the equity tranche, coupon payment would be high. So that type of structures can be seen in asset-backed securities. So this is the generally the structure or the process that we use. These are originator who has already grant loans to individuals. It may be real estate or mortgage, student loans, whatever. Then this originator creates a special purpose vehicle, which is sort of a different company, not on the balance sheet of this originator. It's a separate entity, but owned by this company, kind of. Then transfer that as assets to this company. This is the first thing. Sale of securitized property assets. So whatever the pool of assets is sold to the special purpose vehicle. Then this special purpose vehicle which will issue bonds to the investors. Investors will by paying the notional principal of bonds to the SPV will pass that cash flow to the originator. to buy this as a pool of assets. Then credit enhancer, it can be an insurance company or a guarantor will give a guarantee to this special purpose vehicle, saying that okay, if they fail to pay through this pool of assets, then we will pay or something like that. That will give a credit enhancement. So therefore they can get a higher credit rating. And servicer, there's a servicing agent. He is the one who's responsible to go for these each and every assets and collect the monthly payments. Again, this may be an arm of the originator as well, because it is easy, because they know the customers and they have the information. And it is easy for the customer also to pay back to the originator, because they borrow from, say, if you take a loan from a bank, you would like to pay it back to the bank. It is easy. So you know that whether it loan has been sold to some other party, it doesn't matter for you. So therefore, practically that would happen. But this service agent is responsible to monitor that and get that cash flow. Once this cash flow is received, then based on the agreement, special purpose vehicle will pay the interest and maturity proceeds, or if there's any principal, to the investors until everyone is paid, if there's enough cash flow. If there's no enough cash flow, then the bond will default, depending on if there are any tranches, depending on the tranching structure. That is the simplest form of a working of a asset-backed security. So this process, why do we do this? Say, if you have mortgage loans as a bank, you have given loans to customers, individuals, then you don't have liquidity. You don't have money because it's already given to the customers. And on your books, there's a set of loans, but you can't do anything with that loan. You can't sell. If you have a government security, government bond, whenever you need cash, you can sell it. But a loan, you can't sell it. It is a liquid asset that you have. But through this repackaging and securitization, you can sell that set of assets to another entity and get your funds back. Then you can grant more loans to customers. And then the other thing is, since you don't hold that individual loans in your books, your capital requirement also will be less, because you don't take that risk. You are not carrying that risk on your balance sheet. But to do that, this trust structure is required. That is the SPV. And to attract investors, you need the credit enhancement to achieve the investment grade bond rating. Then there will be a lot of investors, they will prefer to buy it, and there will be a cash flow to the trustee or the SPV. So it can be a form of external guarantee. So what does it mean, external guarantee? This credit enhancer is not the original company originator. It is completely outsider from this firm. That is what meant by credit guarantor. To get that credit guarantee, you has to pay a premium. It's like buying an insurance. Internally, what you can do, over collateralization. What does it mean? If you issue a bond worth of 1 billion rupees, you should have a pool of collateral worth of, say, 1.2 billion rupees. Then that 0.2 billion rupees is the extra cushion over collateralization. That is one way of getting a credit enhancement, because the risk, even part of the asset pool defaulted, you may have enough cash flows to pay back to the investors in the asset-backed security. As I mentioned, mortgage-backed securities is a specific type of asset-backed security which is backed by mortgage loans, especially housing loan, not a commercial properties, but housing mortgages. So you know what is a real estate or a mortgage. So if the borrower defaults, lender has the right to seize that and acquire that property. Then you can sell it. So therefore, at least you have some asset. Even though borrower defaulted, you may not lose everything depending on the market condition on the real estate market. If the prices has gone up, you may recover more than what you should receive, but you cannot recover everything. If it is sold at higher price than the amount owed to you, then the rest you have to pay for the borrower. However, if it is the case, you will recover fully. But if the market has gone down, then you may not be able to recover the full amount. That risk is there. So basically, mortgage loans are originated by banks and other financial firms. So banks issue mortgage loans to individuals. So problem here is, if you grant a loan to keep it on your balance sheet, you will do a proper analysis and decide the terms and the conditions of the loan. But the thing is, in this mortgage-backed securities or asset-backed securities, that's the sort of a weakness or the problem we face. There's a moral hazard problem, because since you know that once you grant the loan, you are going to sell it to another party, you don't mind whether this borrower will pay it or not, because there won't be any loss to you. So therefore, there's a problem that the originator may not do the or perform the analysis very well. That weakness or the drawback is there in these asset-backed securities or mortgage-backed securities. So as I mentioned, once you grant the loan, it can be held on your balance sheet, or you can sell to an investor for cash, or pool it and do the securitization. That's what we do in a mortgage-backed security. So credit ratings. So sorry, that's the basic introduction of the asset-backed securities and specific type mortgage-backed securities. But now we are moving into the bond classification based on the credit ratings. If you can remember, if we go back here, I mentioned that based on the credit ratings, you can classify these. That's what we are trying to discuss now. Based on the credit ratings of the bond. So you know the best rating is AAA. This notation may vary from the rating, depending on the rating agency, because Moody's has a different notification. A. This is the Moody's rating. This is S&P and Fitch. So then AA plus, AA minus likewise. Then there will be triple B rating, and below that at the bottom you have D, CC, or C minus likewise. So investment grade means whatever in the triple B and above. Below that we call it junk bonds or non-investment grade bonds. So bonds in this area is very prone to make default. So high risky. This is the risk category. Triple B and above, it's the investment grade. You can expect high probability that the bond will be paid back. So that is the classification that we do on bonds based on the credit ratings. You might have heard this is an investment grade bond and this is a junk bond or a high yield, or also called high yield bonds. Junk bonds are also called high yield bonds because it, due to risk, it carries a high return. So it's all about the classification or the type of bonds. If you have any questions, please ask. Any questions? So if you don't have any questions, we'll move to the next presentation. With the time, I think it's better. We'll discuss about the primary bond market. So what's the primary market? What is the primary market? That's where a security or an asset is issued for the very first time. That's the primary market. So primary bond market is the place where we issue the particular bond to the market for the first time. So that can be primary market can be new issue of, it can be bonds, bills, commercial papers, or stocks. Generally primary market. Here just primary market, it's not the primary bond market. It is the place where we issue new issues of bonds, bills, commercial papers, or shares. It can be common shares or preferential shares issued by maybe governments, maybe state, maybe municipals, maybe supranational, whatever the issuer category that we discuss. Why do they do this? To acquire capital. So in the primary market, whenever they issue any of these sort of instrument in the market, the proceeds go to the issuer. The proceed go to the issuer. That's the key. But in the secondary market, so basically in the primary market, it's a transaction between the investor and the borrower. Investor and the borrower. In the secondary market, who are the participants? In the secondary market, the transaction is taken place between two investors. One investor is selling the asset that he is holding, the other one buys that investment. So the transaction is taken place between two investors. Therefore, cash flow will be between two investors. Nothing to do with the original issuer. That's the difference in the primary market and the secondary market. So here our focus is the primary markets for bonds. So that's the place, that's the primary market where we distribute the new issue among the investors of that particular bond. We announce that, then we price it, then we distribute it and make the payment. So that is the new bond issue process. So for the first time, a particular series or a particular bond is issued to the market. So these steps will be there. So announcement, what does it mean by announce? So the issuer, through a investment bank or set of investment banks, make an announcement to the public that we are issuing a bond with these characteristics. It may say, okay, whether it's a fixed coupon rate or a floating rate, what is the principal amount or the face value that they are going to target, what is the maturity period, what is the currency, in which market, all those things will be announced to the market. Then in the pricing step, they will ask for investors to submit their interest. What is the amount that they are willing to borrow, at what price? Based on this information, that lead manager, we call lead manager, who handles this process, will decide the price with the discussion of the issuer. And that pricing should be fair for the both side, investor and for the borrower. So that's the role of the investment manager or the lead manager, to do it on a fairly basis. Once the price is decided, then the investment or the bank or the lead manager has to decide, okay, if we decide the price at this level, who are the investors that will receive this bond and what are the amounts? So that will be decided by the lead manager and allocate the security in different quantities for those investors. That is the distributor. So allocate that to all these parties and collect the payment and make that payment to the issuer. That's the last part. But after that, even the coupon payments, maturity proceed payments are done through that book runner or the investment lead manager. So that's the basic process. But who are the parties involved in, how do you do that? That again depends on the type of the bond. What is the process that we are using to issue a government bond in the local market? What is the process that we are using when a government issue a foreign currency denominated debt in the international market? It's not the same. We may have to follow different procedures. How does a corporate issue a bond? That again follows a different procedure. So supranationals. So likewise. So we'll try to understand these things in this session. So there are three main types of primary markets. First one is the privately negotiated public bond deals. So basically this is used by corporates or financial institutions, corporates. So financial institutions will negotiate with possible investors on behalf of a corporate. Corporate wants to borrow, issue in a bond. It may not announce publicly, but the investment bank will approach different investors and ask, okay, see, this corporate is going to issue a bond. This is the amount they need. We think it will price somewhere here. What is your interest? Or that party investor may say, no, okay, this price is not fair for me. I want this much yield or this at this price. Try to come to a negotiation and allocate it. If both parties agree to allocate some funds or the securities for the investor and get that. That is the privately negotiated public bond deals. What does it mean by public? It is issued to the public individuals, but through a private negotiation, one-to-one negotiation with possible investors. Basically, this method is used by corporates because sometimes they might have some advantages of doing that. So then the third one, private placements of non-public debt issues. This is not for the public, but they will specifically target large-scale institutional investors like provident funds, insurance companies, or the banks. Likewise, specifically target those categories and place with them. Again, it is a discussion between the investor and the borrower, but the investor is large-scale investors. Third one is the public auction, in which you make the announcements to the public and ask public to submit their bids and decide what is the price or the yield of that particular bond. Basically, or generally, government securities are issued in that manner. In any country, government securities are issued through an public auction, but corporates mostly use privately negotiated public bond deals or the private placements method of non-public debt issues. So we are not going to focus the first two methods here mostly, but we will discuss a lot on the auction procedure. So what does it mean by pricing? So if you go back here, you can see announcement, then priced. What is pricing? That is the terms that we decide between these parties: the issuer, financial institution, lead managers, and investors. The issuer is the party who is going to borrow. Financial institutions and lead managers, the intermediaries who are involved in this process, evaluating the issuer. What is its credit worthiness? What is the value of assets that they have? What are the future prospects of that issuer? Whether the issuer will be able to pay this. That analysis is done by financial institutions and lead managers. Lead managers go to the market and try to sell this bond as much as possible among investors. Investors are the ultimate investors who is willing to lend money to the issuer. So in the pricing, all these parties come to an agreement and decide the following terms. What is the coupon rate? whether you pay 10% coupon or a 5% coupon or 6% coupon. If you, or it can be the spread as we saw. If it is a floating rate note, there can be a margin added. In a floating rate note, margin is the term that we have to decide, because the reference rate is decided by the market through other transactions or the demand and supply mechanism in the market. It's not by just the investor and issuer in this bond. But if it is a fixed coupon, that coupon rate has to be decided. Sometimes the issuer will announce, okay, this is the coupon rate. Sometimes even the issuer, financial institution, and the lead managers analyze the market and decide, okay, if we set the coupon rate at this level, this would be the optimal. So there will be a demand from the market to buy that, and that is the sort of interest rate cost to the issuer. It is fair for the borrower's side as well. Investor may not that much involved in that coupon rate, but in some instances, coupon rate is decided after the after receiving the investor's interest. They would say, okay, I can buy this, but I need this much yield. So considering that, the borrower can decide the coupon rate in such a way that they attract more investors, meantime, while getting or incurring a appropriate or manageable interest cost. So once the coupon rate or the spread is decided, then the issue price, at what price that we are going to issue this bond. Definitely, it is not required to be at the par, face value. It may be more than face value, or it may be at the face value, or it may be less than the face value. So especially, say, for an example, in US Treasury, when they issue government securities, they just announce the amount and the tenor. The government is going to borrow 1 billion US dollar for a 5-year period. This is the maturity date. Then to the auction, investors will submit their bids. Okay, I would like to, I need the yield of 1.78. Someone say, okay, I need the yield of 1.79. I need a yield of 1.76, something like that. So they will then based on the auction, they will decide what is the appropriate yield by the Treasury, US Treasury. Then they set the coupon rate just above the weighted average yield that they got, to make it the bond is issued at slightly below par. They set the coupon rate slightly higher than the yield asked by the market, which is known to the market. So therefore, market does not worry about the coupon rate. They just ask whatever the yield that they require. Then they will get a coupon rate closer to that, and it is issued at a discount. So people or the investors prefer to buy bonds at a discount. So that's how one issuer work or allocate or decide the coupon rate in the market. But depending on the issuer and the market condition, that may vary. Then in this process, it is decided what are the fees to lead managers and other management or the intermediaries. Indeed, before they come to an agreement to go ahead, they decide these terms. Then only they go to the market and announce. After selection of the bond issuer or the lead manager, only they go to the market. These things happen generally at the beginning, but after pricing only or after issuance only, you make the payment to the lead manager. There's a cost. So whatever the proceeds received through the bond issue, it may not get by the borrower as it is, because there are fees and other charges to be paid to different parties. Fees to lead managers within lead, or then you have to hire legal counsels, you have to pay for that legal counsels, and there are a lot of things behind the screen which incur cost. So when you issue a bond, you have to think about that as well. Other costs involved in the transaction cost of the involved in this transaction. So when publicly issued corporate bonds, definitely financial institutions, intermediaries between corporate borrower and bond investors, borrower, the corporate will hire a investment bank or few investment banks to help them to issue the bond successfully. They will guide, the intermediaries will guide the corporate, okay, you better go for this much of maturity, this type of structure, this would be the desirable coupon, these are the fees that we charge. All those things will negotiate between financial intermediary or the lead manager and the corporate borrower, then we'll announce that to the market. So definitely financial institution will negotiate on the coupon and the price and fees. The financial institution will give a indicative price. Okay, this will be priced somewhere near, somewhere 6% or somewhere 8%, something like that. That will be a guide to the market. Then the market participants will do their own analysis and come up with their own pricing. So in public corporate bonds issues, this method is also a common method, both deals. What does it mean? In that, issuer says, okay, I want to borrow 1 billion rupees. Then the lead manager say, okay, we'll buy that whole lot. Come to agreement with the issuer, okay, this is the price. At this price, we'll buy the whole lot. Then issuer does not take any risk of the market, because if you go to the public, there may be, it may be able to sell the whole bond or may not get the desired interest level, or market participant may ask for a high interest level, and you may not be able to sell the whole issue. But in this, you don't have that. Once you agree the price, if it is okay to the issuer, the lead manager will buy the whole lot. Whether then it will be able to sell it back to other investors or not, it doesn't matter for the issuer, because issuer has collected the money required and knows the cost as well. But the lead manager, once the lead manager bought that everything, whole lot, then they will try to sell it in the market to other investors while taking a risk, because other investors may not pay the price that the lead manager pays to the issuer, or maybe at a higher price. That depends. So however, lead manager take a risk and go ahead with this issue. That is called bought deal. So whenever corporate issue a bond publicly, it requires few things. Even in Sri Lanka, the corporate has to register that in the Colombo Stock Exchange. You may have to get the credit ratings. Then only it it is easy for the investors to evaluate what is the credit rating, because no one can go and evaluate the issuer individually. It is costly, and maybe you may not get the all required information. But rating agencies, they can ask for more information whenever they need, and it's even the issuer is willing to give that information. They know that confidentiality will be there. They will give a good rating for the firm. So that is there. So again, all these things carry a significant burdens to the borrower. Those are part of the transaction cost to the borrower. Registration, there will be a registration fee. Credit rating, you have to pay for the credit rating agencies. Credit rating agencies are paid by the borrower or the issuer, not by the investors. So in the private placements, it is a negotiate directly between the issuer and the few investors, generally institutional investors. So the key thing is, if it is a public issue, then it can be traded in the secondary market. But if it is a public, not public one, private placement, you cannot trade it in the secondary market. The initial buyer, he has to, or that party has to keep it until maturity. There's no way that you can sell it to another party in the secondary market. So therefore, may not require any registration, because it's just an agreement between two parties or few parties. Indeed, it's set of agreements between two parties, borrower and investor 1, borrower and investor 2, borrower and investor 3, bilateral agreements. So on the other hand, investors, they will get the credit risk diversification. They can invest in many that type of borrowers. For the borrower, they may get a, sorry, for the investor, they may get a yield enhancements, because they can bargain and ask for some high return. But the concern is, it is illiquid. Investor cannot sell it to another investor. Investor has to hold it until maturity. That's the drawback in the private placements. And other thing is, it is not transparent. The same product you may buy, say, paying 90 rupees, another party may buy it at 89 rupees. You don't know. So there's no transparency, lack of transparent. But if you're happy to buy at that price, it's okay. But against all these methods, bond auction is the sort of more transparent mechanism. Even in the auctions, there are few methods. So the first one is regular auctions with single price. Regular auctions, single price. So I'll explain what does it mean by single price and multiple price through an example. But what does it mean by regular auctions? So in Sri Lanka, what is the regularity of issuing treasury bills? Do you know? Do you have any idea? When do we have the bill auction? Is it regular? Yes, every week on Wednesday there's a bill auction. So it's a regular auction. Likewise, in many countries or other countries, they have a schedule. Every month we are issuing a 10-year bond. Or every 2-3 months we are issuing a 10-year bond. Likewise. So they follow a regular pattern to issue bonds. So that is we call regular auctions. It's not like whenever we want come go to the market and say, okay, we want to borrow. It's not. That is ad hoc. When it is required, go to the market and borrow. But in a regular auction, every month or every week or every 3 months or every 6 months, there will be a issue from this issuer. So people may wait until that happens. So it may give you borrower more liquidity. Investors, they prefer if the borrower comes to the market regularly, because that will add the liquidity to the market. And the third one is the tap system, that is issuing or adding additional bonds to an existing or the outstanding issue. Say government has issued a 10-year bond last month with a face value of 1 billion rupees. In this month also government can say, okay, we are issuing more, 500 million more on the same bond. That is a tap issue. So then once this auction is over and accepted everything, then the issue size would increase from 1 billion to 1.5 billion. So issuing the same bond later, top up the outstanding amount. That is we call a tap system. So, but again, it's through an auction, not ad hoc basis or private placement. So these are the key or the main mechanisms in bond auctions, followed by different participants. We will go through this and see what does it mean. This multiple price, we'll discuss multiple price, then you can understand what does it mean by a single price. This multiple price auction is called discriminatory price or pay as bid auction. What does it mean? So in an auction, what do you do? The issuer will announce, we want to borrow this much of amount for this period, say 1 billion rupees for a five-year period. Then as an investor, you can say, okay, I am willing to buy 10 million at 9%. Someone else would say, I would like to buy 20 million, but 8.75%. Likewise. So in a multiple price auction, what do? They allocate bonds to different parties, investors, at the price or the interest rate they quote. So therefore, different investors will get the same bond at different prices, depending on what is the price that they quote. If I say I need 9%, I will get it at 9%. If someone else said I need it 8.75 or 9.25, I will get it at that price. So different investors will get different prices. That is called multiple price. In a single price, contrast to this, everyone, who wins the bid, will pay the same price. Generally, the lowest price accepted. Even though you said you would like to buy it 9% and someone say 9.25, another one 9.5%. If the bids are accepted at 9.5%, you also get 9.5. It's not 9%. So that is the difference between multiple price and the single price. So in this, either way, multiple price or the single price option, what do? Bidders submit their competitive bids in a sealed manner. Now it's not sealed in an envelope and submit it. Now it's through electronic media, and the system will take care of the bidding process. No one can log into that and see what are the bids submitted. It will automatically sort out and give you the results. So this is the key. Each winning competitive bidder pays the bid price that she submitted. So as I mentioned, if you submit 9% and you are a winning bidder, you will get it at 9%. If someone else bid at 8.75 and a winning bidder, it will get at 8.75. That is the multiple price bid. And in some countries, some issuance, they will allocate some portion to non-competitive bidders. What does it mean? So those who buy small quantities, they can buy it at the weighted average price of the competitive bidding. So non-competitive bidders, what they have to mention is just the amount. I would like to buy 1 million, 2 million, or 500,000. So the issuer will add the total amount of non-competitive bidders that receive. That will be deducted from the total issuance size. Say the total issuance size is 1 billion. Then you receive non-competitive bids of 200 million. What's the difference between 1 billion and 200 million? It is 800 million. This 800 million will be allocated among the competitive bidders. If the weighted average comes as, say, 8.68, non-competitive bidders will receive this 200 million at 8.68, this weighted average. That's how it works. So in a single price, we call it uniform price option. So every bidder will get, still all bidders submit their bids in a sealed manner. So that means no one can see what is their bid price. But each winning competitive bidder pays the highest losing bid or the lowest winning bid. So it is an advantage for the bidders. You don't worry about when you too much worry about your price. If it is too high price, still you buy it at a lower price. If you are not the lowest, if someone else the lowest, you pay at that price. Again, even in this method, non-competitive bidders are allocated on the same manner at the weighted average of the winning competitive bids. So there's a method called Dutch auction. It is called descending price auction. It is a uniform price auction with the auction price equals to the lowest winning bid. This is single price method. There are bids you receive, then you select from the highest price to lowest price and draw the line and allocate at the lowest price. So with this example, you will get more understanding. Say, for example, a company wants to sell 10 million worth of bonds. This is the face value. Remember, this is the face value. 10 million worth of bonds. So 5 bidders have submitted their bids. To make it easy, I have already sorted according to the price, but not necessarily you will get, okay, however you get 5 prices by 5 quantities. So assume bidder A has submitted the price 96 and he is willing to buy 1 million. Party B, bidder B, willing to pay 95 and to buy 4 million. Generally, what would happen when quantity increases, price decreases. So party C agrees to buy 94 at 94, but 5 million. Party D agrees to buy at 93, but only 3 million. So whatever the quotes that you received, you order them in the descending price. That's why it says descending price option. Thing that what you have to do, order it at the top, highest price, and to the lowest in the descending order of the price, then the corresponding quantities. So now what you do, you allocate 1 million to the party who is willing to buy this at 96. So you allocate 1 million. Then go to the second one. If you allocate 4 million to this bidder, party B, altogether you have allocated 5 million. 4 million to party B, 1 million to party A, altogether 5 million. So this is the cumulative amount. You do that until the end. So if you allocate 1 million to party A, cumulative amount is 1 million. You allocate another 4 million to party B, then altogether 5 billion. You allocate another 5 million to party B. You allocate 10 million. You allocate 3 million to party D, then 13 million. But your requirement is only 10 million. So therefore, you fulfill your requirement when it comes to this level. So this is the cutoff line. You don't allocate anything or any bidder below this line. So party D is a loser. He is not a winner. But party ABC, they are winners. They are winners. Now the difference. If it is a single price method, the price paid by party A would be, this is the lowest price, no, accepted lowest price. So party A also pay 94, party B pays 94, party C also pays 94. This is the single price method. What is the lowest accepted price? All winners will pay the same price. Is it clear? All winners in a single price auction, all winners pay the lowest accepted price. So party A pay 94 rupees and buy 1 million. Party B pays 94 rupees and buys 4 million. Party C pays 94 rupees and buys 5 million. Correct? Clear? That's how a single price auction works. But if it is a multiple price, it won't work like that. Party A quotes 96. So Party A pays 96. Party B quotes 95. Party B quotes, Party B pays 95. Party C quotes 94. So therefore Party C pays 94. Different people or the different bidders, winners will get it at different prices depending on their quoted price. That's the difference between single price and a multiple price auction. Okay, what is the weighted average price in a single price and a multiple price? In a single price, weighted average is just 94 because everybody gets at the same price. But at the multiple price, what is the weighted average? How do you calculate the weighted average? It would be what is the weighted average price? Party A receives 1 million at 96. Party B receives 4 million at 95. Party C receives 5 million at 94. Divide by 1 plus 4, 5, 5 plus 5. So that's the weighted average price. It could be between 96 and 94. What's the answer? 96 plus 280 plus 470 divided by 10. So the weighted average price is 94.6. Weighted average price is 94.6. Now you can see the party C or once the results is announced with the weighted average. So after the auction, it won't announce that saying that party A receives 1 million at 96 and party B receives 4 million at 95 like that. No, individual quotes won't be published, but the weighted average price. So once the weighted average price is announced, market will consider this as the market price. Now you can see party A and party B are losing because they bought it at 96 and 95, whereas the weighted average is 94.6. But party A makes a profit. So that one we call winner's curse. Even though party A and party B are winners in this auction, they lose. So they are subject to winner's curse in a multiple price auction. But it is not there in a single price auction. Any question? So after this, if you can understand this, that's it. After that, what we have, what are the advantages and disadvantages of these different type of two type of options, single price and multiple price. If you have any question. Any question, please?
So what type of options the central bank uses when regarding they are doing bond options?
What do we have in local market?
Yeah.
Any answer? Any answer? We have the single price auction, Dutch auction method. Any other questions? Any other questions? So if not, we'll move forward. So as I mentioned, once the weighted average is announced, it doesn't matter what are the individual prices paid by individual investors. What matters is the weighted average. So everybody pays the same value in the secondary market. If it is the single price, yes, everybody bought it at the same price, then that would be the market price. If it is a multiple price, it is not the case. Some are losing, some are gaining, even the winners. So therefore, this asymmetry of information matters here. Each buyer has an unbiased private value of the uniform unknown value they are going to face on the secondary market, because what they paid is different from what they are receiving in the secondary market. Depending on that, they may make a profit or the loss. However, depending on their information, whatever the information they had based on their pricing. So however, the average of all these is believed to reflect the actual market price, and therefore it is close to the actual value. That's what happened in the auction. So average price will reflect the average view of the market or the fair value of the market. So when you go for an auction as the issuer's main purpose of to raise funds at the cheapest cost. You can raise funds maybe at a higher cost, but it's not the objective of the issuer. Issuer try to get the maximum, but at the maximum amount at the lowest cost. So therefore, the seller or the issuer must set the right incentives and lower the risk of the buyers as much as possible in order for them not to underbid. So if you don't set the platform properly, as the issuer, there may not be enough buyers. They may not come to the bond auction and to buy the bond. So therefore, as the issuer, you should give all the right incentives, give the incentives to the bidders to submit their bids, because then only you can borrow the maximum but at the lowest cost possible. You may prefer to borrow at 2%, but market may require 5% or 7%. You can't avoid that and borrow at 2%. If you try to do that, there will be repercussions. So therefore, both parties face the cost of gathering information. From the issuer's perspective, issuer should gather information about the market and market participants, what is their risk appetite, return requirement, which sector, or that means which maturity sector they prefer. Depending on the market conditions, sometimes investors may prefer to invest in the short end. Sometimes they may prefer to invest in long end. But say provident funds or insurance companies like our other superannuation funds, those who have funds for a longer period, they may prefer to invest in the at the longer end. So as the issuer, you should collect as much as possible public information and evaluate where would be the appetite, whether it would be in the short end or the medium term or the long end, for a fixed coupon or a floating coupon, things like that, especially if you are a corporate borrower. So on the other hand, as the lender, you should know almost the same information about, because that reflects the appetite of the other lenders, whether they want to borrow shorter lend for the shorter period or a longer period or the medium term period, what would be the rate that they would ask, what is my required rate, all those things. Not only that, as the investor should know about the borrower as well. What is the borrower funding requirement, and what is he going to do with this borrowing, whether that will give a profitable profit, or whether they are going to invest these borrowed funds in a profitable investment or not. What's the repayment capacity? Then what is the risk that you incur? What would be the risk premium that you should add? Considering all those things, you submit your bids. So therefore, both parties, there's a cost of gathering information. So you may use different forecast models. You may gather secondary market information. Say government is going to issue a 5-year bond. You would see what is the yield of an existing 5-year bond, or what is the closest to 5-year. What would be the yield? So then you can get some idea. What would happen if this is underbid, so not subscribed fully? That has to be thought by the issuer. What would be the cost? If you go for the second time to the market, definitely you have to pay more, because participants know that investors are not willing to buy this. They are not keen to buy this. So you need more, you will ask for more interest. So that is not good for the issuer. So like that, both borrower and the investor has to gather information, and there's a cost on that. Then the cost of reselling after the bond auction. So not only that, if as the borrower, if you are to rebid it or go for not rebid, re-auction it, what would be the cost? That type of things that you have to think. But when deciding whether you should go for a uniform price method or the multiple price method, there are advantages and disadvantages. One thing is given here. It is proposed that the seller might save up to 75 basis points if he switches to uniform price options. Why? There's something there. Say, if it is a multiple price, how do you bid? As the investor, you try to get the lowest price as much as possible. So therefore, your bid will be at a lower price. That is the cost to the issuer, because you want to, you know that if you are in the winning side, you have to pay that price. Then you are worried about that price as well in the multiple price auction. But in a uniform price auction, you know that if you fall into the winning side, still you pay the minimum price. So therefore, what you want to do, be in the winners group. That's it. So you tend to bid at a slightly higher price just to be in the winner's side. So everybody would do that. So therefore, price will slightly go up. That will give an advantage to the borrower. The borrower can collect more money through the multiple price auction, uniform price auction, because investors will tend to bid at a higher price just to be in the winning side. That advantage is there. So when it goes to the secondary market, as I mentioned, so if it is a multiple price auction, if your cost is above the weighted average, you are losing. If it is below the weighted average, you are gaining. And after that, this will give a signal to the secondary market as well. The weighted average price send a signal to the secondary market. So this is the winner's curse, as I mentioned. If you buy at a higher price than the average, so you are losing. Even though you win the bid, you lose on the